All right, quick favor before we start. If you care about real money and real timing, stick with me for the next 15 minutes, because something just snapped in the silver market. We're talking about a metal that was ripping higher, flirting with levels we haven't seen since the early 1980s, pushing near that $120 area, and then, bang, roughly 15% gone in a blink. Not days, not weeks, minutes. And here's the part most people are getting completely wrong. This wasn't random volatility. This wasn't retail panic. The real trigger just hit. And once you see it, you'll never look at safe haven trades the same way again. Stay with me, because I'm going to show you exactly what just happened, why it was almost inevitable, and how you can spot this setup before the next air pocket drop shows up in whatever market you're watching. Before I explain what caused this move, let me teach you something most people don't actually internalize about markets. Price doesn't move because something is good or bad. That's not how this works. Price moves because positioning gets stretched. Think of markets like a crowded elevator. Everything feels fine on the way up. Actually feels kind of exciting. People are smiling, checking their phones, watching the numbers climb. But once it's packed wall to wall, all it takes is one sudden jolt and people start spilling out fast. Silver wasn't just rising, it was accelerating. Momentum funds piled in. Leveraged traders chased breakouts. Social media amplified the move. And when everyone's on the same side of the boat, when everyone's leaning the same direction at the same time, stability becomes an illusion. That's the setup you need to recognize in any market you're watching, because when momentum replaces balance, when the trade gets to consensus, price becomes fragile. Not because fundamentals changed, because the structure underneath changed. So what does that tell us? It tells us that before you can understand what happened this week, you need to understand what was building for weeks before that. Now here's what's actually happening under the hood. Let me break down the sequence, because this is where the lesson lives. The primary driver was a sudden surge in the US dollar. That didn't come out of nowhere. Renewed uncertainty around Federal Reserve leadership sent shockwaves through currency markets. And when the dollar catches a bid like that, it's not subtle, it's not gentle. Precious metals feel it immediately. Silver especially, because it trades like a hybrid, part industrial metal, part monetary asset, part leveraged speculation vehicle. So when the dollar jumped, silver didn't just dip, it cracked. Here's why that matters. Silver's priced in dollars globally. When the dollar strengthens sharply, it takes more foreign currency to buy the same amount of silver. That creates instant selling pressure from international buyers. They're not suddenly bearish on silver. They're dealing with currency math that just changed on them. That's the first domino. Then came the secondary confirmation, and this is where things got mechanical. Futures positioning. Leveraged longs started hitting margin thresholds. When you're trading silver futures on leverage, you're not just betting on direction. You're betting that price won't move against you faster than your account can handle. And when volatility spikes and price drops hard, brokers don't ask nicely. They liquidate positions, stops got triggered, forced selling kicked in, and that's when volatility turns from emotional to mechanical. Here's what's wild about this. Nobody needs to decide to sell at that point. The system sells for them. Computers execute. Risk models fire. And when that happens into thin liquidity, when it happens during hours when major market makers aren't fully staffed, price doesn't walk down the stairs. It drops through the floor. But here's the part that should make you nervous and also make you smarter. This wasn't about silver's fundamentals changing overnight. Global supply didn't suddenly double. Industrial demand didn't collapse. Central banks didn't dump their reserves. This was about the trade getting too crowded at the exact wrong moment. When you've got leveraged speculators stacked on top of momentum chasers stacked on top of retail FOMO, all you need is one sharp reversal to trigger a cascade. And that's exactly what we got. The dollar spiked, margin calls hit, algorithms kicked in, and 15% vanished faster than most people could refresh their screens. Now let me show you what very few people are talking about. The speed of this move tells you something critical about market structure. When you see a decline that sharp, that fast, you're not watching informed sellers making careful decisions. You're watching forced liquidation. You're watching leverage unwind. And that creates something really important. It creates information. Because after forced selling exhausts itself, after the margin calls clear and the stops finish executing, you get to see what real demand looks like. Does price stabilize? Does it recover some of that loss? Or does it keep bleeding because the underlying bid was never really there? That's the question we're watching right now. And the answer will tell you whether this was a shakeout or the start of something worse. This is the exact same playbook we've seen before. Zoom out and you see it clearly. In 2011, silver went parabolic. I mean, absolutely vertical. It ran from around $18 in late 2010 to nearly $50 by April 2011. Sentiment went euphoric. Everyone and their cousin was buying silver. And then a brutal pullback shocked everyone who thought the move was invincible. Silver dropped 30% in 5 days. 5 days. People thought the world was ending. They thought it was manipulation. They thought the rally was over. What happened next? Silver chopped around for months, reset positioning, and then actually held elevated levels for years. The point isn't that it went straight back up. The point is the correction didn't end the larger story. Fast forward to 2020. After that explosive post-pandemic rally, when silver ripped from $15 to nearly $30 in just a few months, it sold off violently again when liquidity tightened and the dollar firmed. Same pattern. Crowded positioning, sharp reversal, everyone freaking out. And then what? Silver stabilized, consolidated, and remained well above pre-rally levels. The larger trend stayed intact, even though the short-term move felt devastating if you were caught wrong. And every time this has happened, the sell-off didn't mark the end of the story. It marked an inflection point. When you look at the pattern across decades, these sharp resets tend to shake out weak hands, reset leverage, and determine whether the next leg higher gets delayed or launched with even more force. The larger story is this. Corrections after parabolic runs are part of the cycle, not proof the cycle is broken. If you're watching this and you've been following silver for years, you've seen this movie before, different actors, same script. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Absolutely. Short-term price action is unstable right now, and pretending otherwise would be dishonest. Could we see $80? Could we see $70? Yeah, we could. And yes, you'll hear people scream manipulation. You'll hear claims this was all pre-planned by big banks or governments or whoever the villain of the week is. Here's the thing. Markets don't need villains when mechanics do the job just fine. You don't need conspiracy to explain leverage unwinding into a surging dollar. You don't need secret meetings to explain what happens when too many traders crowd the same side of a fragile trade. Could there be players taking advantage of that setup? Sure. But focus on what you can control. Watch positioning, watch liquidity, watch the dollar. Those signals tell you far more than outrage ever will. Getting emotional about market structure doesn't change market structure. There are probably 3 types of people watching this right now. Let me speak to each of you directly because your situation matters, and your next move depends on which camp you're in. First, you might be the trader who chased the breakout and now feels blindsided. Maybe you bought silver at 110 or 115, thinking this thing was going to 200 by summer. And now you're down double digits and wondering what the hell just happened. If that's you, take a breath. This wasn't stupidity, it was timing. Your lesson isn't that momentum trading doesn't work. Your lesson is risk management. Momentum works beautifully until it doesn't, and stops aren't optional in crowded trades. If you didn't have a plan for what happens when the trade reverses hard, that's the lesson you just paid tuition for. Don't let emotion compound the loss. Figure out your risk tolerance. Decide if this is still a trade or if it's become a hope, and act accordingly. There's no shame in taking a loss if it keeps you in the game for the next opportunity. Second, you might be the long-term believer in silver who's wondering if this thesis just broke. Maybe you've been stacking physical for years. Maybe you believe in the supply story, the monetary story, the industrial demand story, and now you're watching this pullback and wondering if you got it wrong. Let me be clear. Your thesis didn't break. The long-term fundamentals around silver supply constraints, industrial demand from solar and electronics, monetary uncertainty, none of that changed this week. Your job is patience, not prediction. Volatility doesn't invalidate structural trends. If you bought silver because you believe in the 10-year story, a 15% pullback over a few days is noise. Uncomfortable noise, sure, but noise. This is why physical holders don't use leverage. This is why you don't bet the mortgage on short-term price action. Stay focused on why you're holding, not what the chart did yesterday. Third, you might be on the sidelines, feeling like you missed it. Maybe you were watching silver run and thinking about getting in, but you hesitated. And now you're wondering if the opportunity just passed you by or if this pullback is your chance. Here's what I'll tell you. You didn't miss anything. Corrections create information. They show you who was serious and who was speculating. They reset the technical picture. And information creates opportunity. If you're watching this and you're trying to decide whether to enter now, ask yourself what you're buying and why. Are you buying a bounce? Are you buying a long-term position? Are you trying to catch a falling knife or waiting for stabilization? Your strategy determines your entry, not the price alone. No matter which camp you're in, the universal rule is the same. Don't confuse price damage with structural damage. Price can get hammered while fundamentals stay intact. That's actually when the most interesting opportunities form, but only if you can handle the volatility without panicking. So here's what I want you to answer in the comments. Which type are you? Are you holding through this? Did you get stopped out? Are you waiting on the sidelines? I'm genuinely curious where people are positioned right now because it tells me a lot about market sentiment. So here's where I stand. I'm not panicking and I'm not chasing. I'm watching. Let me tell you what I'm personally watching. First, I'm watching the dollar, because continued strength changes the timeline. If the dollar keeps ripping higher, if we see more volatility around Fed leadership or policy uncertainty, that pressure on silver stays real. It doesn't matter how bullish the silver fundamentals are if the dollar's on a tear. They can both be true. Second, I'm watching how silver behaves after the forced selling exhausts itself. Does it stabilize around the $100 area? Does it reclaim 110? Or does it keep bleeding lower, which would suggest the bid underneath wasn't as strong as people thought? That price action over the next week or two tells you everything about whether this was a shakeout or a structural break. Third, I'm watching institutional forecasts and positioning reports because major banks are still projecting targets near 150 per ounce. That's not a guarantee. That's not advice. But that tension matters. When you've got sharp, short-term selling alongside unchanged, long-term bullish forecasts, somebody's going to be wrong. Either the institutions are too optimistic or the market just handed you a gift. Time will tell which one it is. Based on my analysis, this move was mechanical, not emotional. The fundamental picture around silver supply deficits, industrial demand growth, monetary uncertainty, those pieces didn't evaporate this week. What changed was positioning. What changed was leverage. What changed was the dollar. And those are temporary variables, not permanent conditions. If history rhymes and silver stabilizes after forced selling clears, the move that follows could be significant. But that's not a prediction. That's a pattern observation. Your job is to watch the data, not trust someone else's timeline. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Make your own decisions based on your own risk tolerance and goals. If you made it this far, you're the kind of person who wants to understand how markets actually work, not just react to headlines. That mentality will serve you well. If this breakdown helped you see the bigger picture, do me a favor. Share this with someone who needs to hear it. Subscribe if you want more breakdowns like this when markets move, and drop a comment with where you stand right now. Stay sharp out there. Think critically, verify the data, and always, always make your own decisions.